The head of the Federal Reserve says interest rates likely won't get any higher than they are right now, but central bankers aren't ready to lower them just yet.
If we ease too much or too soon, we could see inflation come back. And if we ease too late, we could do unnecessary harm to employment.
The good news, the Fed still expects 3 quarter-point rate cuts by the end of the year. Inflation has dropped considerably since its peak in summer of 2022. The job market is also strong, with the longest streak of unemployment below 4% since the 1960s. So with the economy looking this good on paper, why do polls and surveys show Americans don't feel good? A group at Harvard, which includes former Treasury Secretary Larry Summers, may have figured it out. The cost of borrowing money, that's not reflected in how inflation is measured.
Not only did prices rise, but after that, interest rates rose so much, and that's something that has really been weighing on their finances.
It's why they say when interest rates fall, sentiment could rise significantly. Fortunately for retailers, sour sentiment hasn't dealt any major blows to consumer spending. The National Retail Federation is out with its new forecast for the year, showing sales growth losing a bit of steam, but still rising between 2.5% and 3.5%. That's compared to last year's 3.6%. Consumers have proven resilient, helping the economy defy expectations of a recession last year. The question is, how long and how strong can that last? Some experts will turn to the job market for answers.
I believe we will be slower, perhaps about 100,000 jobs less than we had last year. I think it continues to support consumers' attitudes, their behaviors, and I think their spending.
Experts say the pieces are in place for Americans to start feeling better by the end of the year. But as the Fed acknowledges, nothing is certain. In Washington, I'm Atral Nashar reporting.